Every time the economy crashes, we tell the same story. This is the reset. The bubble has burst. The rich will finally take a hit. Things will even out. And for a few months, it looks true. Billionaires lose billions on paper. Stock charts look like cliffs. Headlines scream about wiped out wealth. But then you zoom out. The crash ends, the lines turn back up, and when the dust settles, the people who owned the most going in somehow own even more coming out.
Just like Maria, around 30 other people sleep overnight in their car in this free parking lot. Nevertheless, most of them work. They're security guards, Uber drivers, secretaries, or even computer technicians.
The reset never really happens. The gap doesn't close, it widens. This video is about why. Not the comforting version, bad luck, a few greedy bankers, but the way the system is actually wired. Because a crisis isn't just a storm that hits everyone equally, it's a sorting mechanism. When prices fall, when businesses fail, when people are forced to sell just to stay afloat, that's not the end of the story. It's the beginning of a transfer from whoever has to sell to whoever is allowed to wait or buy.
Sometimes you question, we're in the United States of America. How can the citizens be going through such a issue? We always boast that we're a superpower, that we are the richest in the world, and things just don't make sense.
And under the surface, the rules are not the same for everyone. There is one operating system for labor, for people who live on wages, salaries, and small savings, and a completely different operating system for ownership, for people whose lives run on assets, credit lines, and tax code side doors. Crises expose that gap in Fast Forward. They show you, brutally, who is forced to liquidate their future and who quietly upgrades theirs at a discount. That's the investigation we're going on. Picture two households when a crisis hits. Same country, same shock, same scary headlines, but they are playing on different difficulty settings. Household A is running the labor operating system. Most of their wealth is their paycheck, maybe a little home equity, a 401k that mostly lives in broad index funds, and a few thousands in savings on a good year. Household B is running the ownership operating system. Most of their wealth is in assets, a portfolio of stocks and bonds, maybe some rentals, private business stakes. They also have something Household A doesn't: a long, friendly relationship with a bank. Now, the crisis lands. Stock markets fall 30%, house prices wobble, news notifications get darker every hour. For Household A, the danger isn't abstract. It's the text from work about cutting hours. It's wondering how many missed paychecks they can survive before the mortgage payment is in question. If things go wrong, they don't have positions. They have bills. Maybe they can sell some of their retirement account and lock in that 30% loss, or put groceries on a credit card at 20% interest and hope the job comes back before the promo period ends.
We, unfortunately, in the United States are at the very high end in terms of income inequality. And so what happens is, when the distance gets further and further away, the rungs on the ladder get further away, and it's harder for people to climb those rungs out of poverty into the middle and to the upper class.
The crisis for them is not opportunity, it's a countdown. Household B sees the same headlines, and on paper, they've lost hundreds of thousands, maybe millions, but their bills are paid from cash reserves and dividends. Their mortgage is fixed, and behind the scenes, their bank is already emailing about flexible credit options if they want more liquidity. They don't have to sell. In fact, they're being nudged to borrow against those temporarily cheaper assets, to buy more of whatever is on sale. Same shock, same charts, but one operating system forces you to become a distressed seller at the worst possible moment. The other buys you time, and with time, actual options. This is the first rule of crisis we almost never say out loud. Crises don't distribute pain evenly. They redistribute ownership. From peoples whose lives are wired to the wage system to people whose lives are wired to the asset system. But there's another player in the story that quietly decides how violent that transfer is and how fast each side recovers: the central bank. When the economy slams into a wall, there are two very different rescue timelines. The one you see on the news, unemployment benefits, stimulus checks, emergency programs debated on the floor of Congress, and the one that happens in the background, in a boardroom most voters couldn't find on a map. Central banks are not designed to fix inequality. They're designed to prevent financial collapse. Their job description is simple and brutally narrow: keep the plumbing of money moving. So when a crisis hits, they move fast. They slash interest rates, they promise to buy government bonds, then mortgage bonds, then, if things get bad enough, even corporate bonds. They tell markets in plain language, we will not let this system fail. To most people, this sounds boring. To anyone who owns a lot of financial assets, it is a life raft. Because here's what those tools do: they put a floor under asset prices. They make it cheaper to borrow and easier for big companies and banks to roll over their debts instead of defaulting. If you live in the ownership operating system, that's oxygen. Your portfolio stabilizes, your credit lines stay open, you can refinance, extend, and wait things out. If you live in the labor operating system, none of this shows up directly in your life. Your central bank can't stop your specific job from disappearing. It can't force your landlord to be patient. It can't make your credit card interest rate suddenly compassionate. So you get a split-screen recovery. On one side of the screen, markets bottom out, then rip upward as soon as it's clear the central bank will do whatever it takes. On the other side, layoffs, hiring freezes, and business closures grind through real communities for months or even years. The rescue arrives first where wealth already lives. The wage side gets the aftershock. Once you see that timing difference, you understand why the reset never seems to arrive. Crises knock asset prices down briefly, but the very tools we use to stop a depression end up acting like a trampoline for ownership, while labor hits the ground with no padding.
Well, there's a fear that the far right.
The rest of this video is about what happens next, how that timing gap, repeated crisis after crisis, quietly rewrites who owns what in the economy. Once you understand the two operating systems, labor versus capital, history stops looking like a list of random disasters. It starts looking like a shopping list. Because every major crisis follows the same script. Phase 1 is the panic. The labor market collapses, small businesses run out of cash, families burn through their savings. This creates a massive pool of distressed sellers. Phase 2 is the clearance event. In the Great Depression, 1930s, the distressed asset was land. Small family farms went bust by the thousands. Who bought them? Massive agricultural conglomerates with deep pockets for pennies on the dollar. The family farm died. Industrial agriculture was born. In the Asian financial crisis, 1997, the distressed asset was entire national industries. Countries like South Korea ran out of cash. Who bought them? Western banks and private equity firms, swooping in to buy huge companies at fire sale prices. In the 2008 housing crash, the distressed asset was your home. Millions of families were underwater. Who bought them? Institutional investors like Blackstone, who swept up thousands of single-family homes to turn them into permanent rentals. Do you see the pattern? The cause of the crash changes, but the result is always the same. Assets move from the hands of the many, who are forced to sell, into the hands of the few, who are waiting to buy. Baron Rothschild said it in the 18th century, the time to buy is when there's blood in the streets. But he forgot to mention the most important part. To buy when there's blood in the streets, you need to already have the money. And in the modern economy, the government ensures the people with the money get it faster than anyone else. Which brings us to 2008. 2008 was the moment the mask slipped. We all remember the crash, but the real scandal wasn't the crash, it was the recovery. Remember our two operating systems? Labor owns homes, capital owns stocks. When the bubble burst, both crashed. Housing lost $6 trillion in value. The stock market lost nearly half its value. But then the central bank, the Fed, stepped in. They couldn't buy your house to prop up its value. That would be socialism. But they could buy mortgage-backed securities and bank bonds to prop up the financial system. That was necessary stability. The result was a split-screen recovery that defined a generation. The stock market, capital's asset, bottomed in March 2009. Thanks to the Fed's liquidity, it recovered all its losses by 2013 and went on a historic bull run. The housing market, labor's asset, didn't hit bottom until 2012. It didn't recover its value until 2016. Look at that gap. For 3 years, the stock market was booming while regular people were still drowning in negative equity. If you were wealthy, the crisis was over in 18 months. You used cheap debt to buy cheap stocks, and you got rich. If you were working class, the crisis lasted 7 years. You lost your home, your credit score, and your mobility. 2008 taught the ownership class a valuable lesson. The government will prioritize asset prices over wages. So when the next crisis hit in 2020, they didn't panic. They got ready to buy. If 2008 was the prototype, COVID was the finished product. In March 2020, the economy didn't just slow down, it turned off.
The reason the pandemic has made that worse is because when you talk to large organizations, corporations, what they saw was that staff was leaving, but they had a response to that, right? Their response was, let's give bonuses, let's give raises. Many organizations, many small businesses, government, they don't have that luxury. So inflation has kept up with the money that most people in the 1% have made, but it has deepened and widened the gap between those that have money and those that do not.
Research by MIT.
22 million people lost their jobs in weeks. GDP collapsed. But this time, the Federal Reserve didn't wait. They learned from 2008. They fired the money cannon immediately. They bought bonds, they bought mortgage debt, they even bought corporate debt, essentially lending money directly to Apple and Verizon. The result was the fastest disconnect in economic history. While 20 million people were filing for unemployment, the S&P 500 had its best month since 1987. Think about how insane that is. The economy was closed, but the stock market was hitting all-time highs. Why? Because the ownership operating system had been fully insulated from reality. The Fed made sure that no matter how bad the real economy got, asset prices would not be allowed to fail. The result was a K-shaped recovery. The top arm of the K, people with assets, skyrocketed. American billionaires added $1.2 trillion to their wealth during the pandemic. The bottom arm of the K, service workers, renters, small business owners, crashed. It wasn't a conspiracy. It was simple mechanics. The system is designed to flood the zone with liquidity to save the banks. That liquidity flows into assets first. It trickles down to wages last. By the time the stimulus checks hit your bank account, the assets you wanted to buy, houses, stocks, crypto, had already doubled in price. You got the cash, but they got the inflation. So why do we keep doing this? Why is the standard response to every crisis to bail out asset holders first and hope it helps workers later? It's not just because politicians are bought, though that helps. It's because we're in a structural trap. Our entire economy is now built on the assumption that asset prices must go up. Pension funds need stocks to go up to pay retirees. Banks need home prices to go up to back their loans. Companies need their share price to go up to borrow money to pay staff. We have built a system where the health of the economy is identical to the price of assets. If the government tried to protect labor first, say by letting banks fail and wiping out shareholders to save homeowners, the entire credit system would freeze. ATMs would stop working. Payrolls would bounce. We are hostages. The wealthy hold the economy ransom. They say, save our assets or we take the whole ship down. And every single time, the government pays the ransom.
For the moment, it's not too demanding, but it is going to get more complicated with the second stage, sleeping out in the open, not in the streets, but safely in this fenced yard. However, 53-year-old mother Marta is slightly concerned.
I'm scared of bugs. I'm scared of bugs.
So, what do you do with this? If you are waiting for a crisis to be the great equalizer, stop waiting. The system is not wired to equalize, it's wired to consolidate. When the next crash comes, and it will, do not expect the rules to be fair. Expect them to be consistent. 1. Cash is king, but liquidity is power. The people who win during a crisis aren't just rich, they are liquid. They have access to cash when everyone else is selling. If you are fully invested with zero cash reserves, you are one bad month away from becoming a distressed seller. 2. Don't fight the Fed. Understand that in a modern crisis, the government's first move is to debase the currency to save the bond market. Holding cash long-term is a losing strategy. Holding cash short-term to deploy during the panic is a winning strategy. 3. Know which lane you're in. Are you relying on wages, labor OS, or assets, ownership OS? The goal of financial strategy isn't just saving. It's moving your life inch by inch from the operating system that gets punished to the one that gets rescued. But this leaves a massive, hanging question. If we know this system creates inequality, and we know it makes every crisis worse for the poor, why doesn't the government fix it? Why do they keep patching the tire instead of changing the wheel? That is a much darker story, and it involves a mechanism that most people don't even know exists. That is our next investigation. I'll see you there.